Today we're diving into how Donald Trump's return to office could impact Canadian retirees and investors. A lot of people that have mics and podiums seem to treat this as a bad thing, and I want to give you a more balanced approach. Whether you're watching your budget, planning for your investments, or you're just trying to understand the bigger economic picture, it's crucial to know how the shifts in U.S. policy could ripple through Canada. Here's what we'll be covering today. Number 1, trade policies and tariffs. We'll start with Trump's America First trade policies, including tariffs and protectionism, and discuss why tariffs can be particularly challenging for Canadians. We'll look at the potential strain on our cross-border trade with the U.S. and why this matters to your wallet. The second item is actually a bit of a silver lining, the China trade tension and Canada's advantage. So we'll talk about how Trump's long-standing focus on the U.S.-China trade deficit and how this might actually create opportunities for Canada. In the U.S., they really are trying to shift reliance away from China, and Canada's close trade relationship could make it favorable as an alternative source of raw materials and, of course, energy. There's also the flow of investments and corporate reinvestment. We'll touch on how Trump's pro-business stance and corporate tax reduction policies, which essentially would attract investments back to the U.S. With Canada recently increasing capital gains, this creates contrasting tax environments that could really influence where businesses and entrepreneurs choose to invest or reinvest. Then, of course, there's the stock market and his pro or maybe anti-regulation approach. So let's consider that deregulation. Trump's return could bring back his focus on deregulation and, of course, the corporate tax cuts, which tend to be favorable for the U.S. stock market. We'll explore why the U.S. often performs well under these conditions and what this could mean for Canadians with U.S. investments. And you're probably worried about this. The next point that we have to discuss is the inflation risks from all these policy changes, especially if imports from countries like China are being taxed significantly more. This could essentially bring a situation where there's inflation again and rising price for goods that could stretch Canadian household budgets even further. And I'll help you look at that ahead and see what you can do to prepare. Of course, finally, I want to impart a few financial planning strategies that you still need to keep in focus regardless of who's in power. These are the things that remain unchanged. Good financial planning principles like diversification, tax-efficient withdrawals, and budget management are still the best ways for you to really maintain stability regardless of who is in power in their country or ours. So let's jump in and see what this all means for Canadians and how you can pay attention to this, especially as his inauguration actually comes forward. Trade policies and why tariffs are bad for Canadians. Let's start with trade. Canada and the U.S. share one of the most significant trade relationships in the world. We're actually quite unique. We're so reliant on each other's economy. With a total of $908.9 billion in goods and services exchanged between the two countries in 2022. The U.S. exported $427.7 billion to Canada, making Canada its largest export market. That's significant. We have a bit of power, a bit of leverage to this extent. U.S. goods and services representing 17.3% of all its exports went to the Canadian market. In return, the U.S. imported $481.2 billion from Canada, establishing it as its second largest trading partner overall. This strong economic connection directly supports countless jobs in different industries in both sides of the border. But tariffs, essentially taxes on imports, can disrupt this essential flow of goods and it will increase prices for consumers. For instance, if Trump reintroduces tariffs on Canadian goods, it could make it more expensive for American buyers. Let's talk about the manufacturers, the people that are buying raw materials so that they can produce. This would potentially reduce demand for Canadian resources. For Canadians, on the other hand, this would impact jobs and profits in industries that rely on the U.S. market, especially in export-heavy sectors like oil, lumber, and automotive manufacturing. Furthermore, if tariffs really do start, it goes to the next level, which is tariff retaliation. So Canada will likely try to impose tariffs on the US where it will hurt them, leading to an increased price for Canadian consumers as those goods are being imported inwards. See, higher prices from tariffs could show up on everything, from groceries to household goods, stretching your budget even further. Now, in the end, tariffs don't really benefit everybody equally. It might actually even strain well-established relationships. So it could reduce competitiveness in the market and it increases costs for consumers. Because really, this protectionist measure that Trump is imposing, he is standing by his platform of putting Americans first. He did that in his first term, and he's promising to do the same thing again. By putting tariffs on imports from Canada, it makes U.S. goods and services more attractive. So that's why he's doing it. That's the promise that he's putting forth. But if you follow that a few steps forward, what it ends up doing is impacting our day-to-day lives because of how costs of goods will eventually increase. So this is more of a political attempt to really play chicken. Like, who's going to cut the tariffs first until we come to an agreement? That's what could happen. I'm not saying it will, but it really could harm both countries if we start going down this path of retaliatory tariffs. Let's talk about a potential silver lining. See, Trump's focus would actually probably be directed at China first before Canada, and let's talk about how that could be beneficial to us. I talked to you about the trade arrangement between U.S. and Canada, and there's actually about a $50 billion deficit favoring Canada. It seems like a lot of money, but in the grand scheme, let's look at China. When we add this as another layer of discussion, during Trump's previous term, his trade policies really targeted China with the goal of reducing U.S. reliance with China. And if you look at the numbers, you could see why. Because in 2022, the trade deficit between the U.S. and China was $367 billion. So it's very lopsided towards China's favor. Now, Trump's administration will likely try to impose a wide range of tariffs on Chinese goods, aiming to push American businesses to seek alternative suppliers or bring manufacturing back to the U.S. And he was already doing that before we went through this globalization debacle and the supply chain issues that we had during the pandemic. So now I would see a further emphasis on that. So if these policies continue, what could happen then is Canada could benefit. Canadian businesses could benefit because of the long-standing relationship between the U.S. We could be seen as a more reliable source of resources, raw materials, and imports. This could open doors for Canadian exporters in a way that really might favor us. So we'll end up taking it away from Chinese manufacturing. In short, the tension between the U.S. and China could cause some global trade disruptions. However, if, and it's a big if Canada and our leadership, our government, does what they can to fill the void that this tension will create, it'll actually put us in a great position. So it might balance out the overall tariffs that I pointed out in point one. This could help stabilize certain industries in Canada for job growth. And this, of course, will indirectly benefit Canadian retirees and consumers. Now, let's talk about the flow of money. See, the flow of investments and corporate reinvestments away from Canada. And obviously, the U.S., if Trump's policies continue, it would be a very attractive environment for those dollars to flow into. It's not looking great for Canada from that standpoint. Trump's push for corporate tax cuts in the U.S. could make American investments significantly more attractive, potentially drawing capital away from us in large projects. Here's how this plays out. Lower corporate taxes in the U.S. means companies keep more of their profits if they're focusing their operations there. So if business operates in both Canada and the U.S., where do you think they are more likely to reinvest in growth? With tax rates lower on the American side, it's a strong pull for companies to prioritize U.S. operations over Canadian ones. I don't want to focus heavily on energy, but we've seen this. We've seen a lot of larger energy projects and in fact, even large companies completely pivot to the US in the last 5 years. Now, on top of that, Canada's recent increase in capital gains taxes only adds to the problem. When Canadian business owners, small business owners or investors sell off assets, they are now hit with a bigger tax bill on those capital gains, which effectively reduces their overall returns. For the business owner or the entrepreneur that risks a lot, that extra tax burden could be enough to make them reconsider where they reinvest or whether they reinvest here at all. I mean, why sink more money into the Canadian ventures if you'll lose a chunk of it to taxes anyway? This shift isn't just a numbers game. It's about where these folks feel their investments will pay off best in the long run. And maybe I'm being negative about this, but it honestly could be a drain to us in our competitive advantage on the higher risk entrepreneurial ventures. Many of these individuals will be tempted to shift their funds and perhaps their full operations to the US, where the tax environment is much more favorable. For Canada, this flow of investments south of the border isn't just theoretical. It can have real consequences in our economy. Think about it. Less reinvestment here means less growth and potentially fewer jobs. The reason why we are now finally experiencing some rate cuts is because the numbers, the leading indicators for economic growth is showing weakness. And that, a big part of that is the job growth and unemployment. That's already becoming an issue. This will just get worse if a lot of these businesses actually pull out of Canada and begin to operate more heavily in the US. As a Canadian retiree, this matters because a slower economy can directly impact everything you have, from the values of your real estate to the strength of our dollar. So while these tax policies might seem like they only impact business owners, they can actually create a domino effect that'll affect all of us and it'll affect you. If you're traveling a lot, like many retirees, that's their big goal. Travel just get a lot more expensive if our currency gets weaker because of these policies. Now, for more on the US tax policy, I can link to that in a later video, but really, let's just go back to this. If it's more favorable to invest in the States, money's going to flow there. Investors, business owners are going to flow there. Less reinvestment to Canada, less growth, etc. And that just keeps going in a trend that we don't want. Now, this might be what you were waiting for. Let's talk about the stock market and why it seems to have favored Trump's approach. See, Trump's pro-business stance, particularly his emphasis on cutting red tape and reducing corporate taxes, is something investors tend to welcome with open arms. Why? Because less regulation and lower taxes make it easier for companies to do business and increase profits, and in turn potentially boost stock prices. When Trump was previously in office, we saw him rolling back regulation across various industries from energy to finance, which created a friendlier business environment. The thinking here is simple. If companies have fewer regulatory hoops to jump through, they can get the products that they want to market faster, reduce costs, and focus more on growth. This can make American companies leaner and more profitable, which tends to lift stock prices. See, even if that hasn't happened yet, people are confident that that will. And if you look at just the last week, the markets have ripped and they've opened at record highs. So for Canadian investors with US stock in their portfolio, this can mean stronger returns. See, a business-friendly U.S. environment could attract investments, right? It drives up stock prices and increases dividends. If you're holding U.S. equities, especially in sectors that stand to benefit from fewer restrictions like manufacturing, finance, and energy, you might see a boost in your portfolio. These industries in particular have historically performed well when they face fewer, let's call it compliance costs and regulatory hurdles. The energy sector, for example, saw a wave of optimism when Trump scaled back certain environmental regulations, making it easier and cheaper for companies to operate. For finance, reduced regulation is kind of a double-edged sword. Operating in this industry and operating in this business, I look at that with a little bit more caution, right? Because reduced regulation could potentially lead to harm to the consumer, but that's the market outlook anyway. If it's easier to do business, it's easier for companies to profit. Another piece of Trump's pro-business approach is his preference for lower corporate taxes, which directly benefit shareholders. Remember, dividends are paid after business taxes are already taken care of. So lower taxes means more profit stays within the company, which can then be reinvested to grow the business or have more cash to pay it out to shareholders. In many cases, this will mean favorable returns for that U.S. equity allocation in your portfolio. My hope is that as a Canadian retiree, you're not all U.S., but this is definitely something that would have uplifted your portfolio in the last few days, and the thinking is it will continue to do so. Mind you, this is not investment advice. I'm just following the dots here. Now, there's potentially an increase in stock buybacks as well. That's when a company purchases its own shares from the market. That drives up the price per share, and that could deliver value to the investor. That typically happens when money is cheap. I don't think we're there yet, but that could come. So with this Trump presidency, while it may boost the U.S. market, it's also important to recognize that what has happened in the last week is really confidence-driven, right? If the people believe that there's growth to come, they are more likely to invest. But that could also be borderline greed. So though I'm sharing some positive news from that regard, please be mindful when things are looking too easy. That's when you should begin to temper your expectations, because overconfidence could actually lead to increased volatility. So if there's one debacle, it could be a big retreat. Let's just use that word, right? So it's a balancing act. Let's just make sure that you are aware of that. If you have a lot of U.S. stocks in your portfolio, really, this could offer potential gains, especially if this pro-business climate and pro-business agenda really gets maintained. But since we're talking about markets here, I just want to tell you that the markets are unpredictable. I can be certain of only one thing, that it can either go up or down. So please look at all the other aspects in your life that you can control beyond the market. Now let's look at the ugly word that everybody's been focused on for the last 2 years. It's inflation. The inflation risk that comes with the tariffs and other policies. See, the real concern here is that a big potential impact for Trump's policy is inflation, right? It could be influenced by the tariffs and the restriction on imports. When tariffs are placed on goods from other countries, especially if China is a target once again, prices can rise because imported cost of goods can push manufacturing costs. And guess what? That gets passed on to the consumers like you and I. If inflation returns, it can then erode purchasing power for us and for you. If you're a retiree, it really eats away at your spending power, making everyday expenses feel more expensive over time. For Canadians, if the U.S. inflation goes up, it could also drive prices for us here because of how close the economies are. Now, this kind of inflation, which comes from higher import costs, affects everything: clothing, goods, household goods, everyday groceries. So if you are a retiree and you are living on this notional fixed income, managing your spending in an environment where cost is rising will require significantly more care and planning. So look at your budget, look at what absolutely has to stay the same, and where can you put a little bit of buffer on. But looking ahead, that also means that you should probably increase your planned draws from your portfolio if your plan can sustain it. While we're at that topic, let's talk about good financial planning, because that remains the same. It doesn't matter who is in power. See, while these potential policy shifts may affect the economy, the market, and inflation, good financial planning starts with you. It starts at home. That's why I really mean this. I want you to be your own money hero. To me, this means agency. If the world is already so uncertain, what are the things that are within my control that I can manage? Here are a few points to keep in mind. Number one, stay well-diversified. The well-diversified portfolio of different asset classes, different regions, and different markets helps protect against market swings. You might be tempted to tilt heavily towards the U.S. right now because of how good it has been. Warren Buffett says it all the time. Be greedy when others are fearful, and be fearful when others are greedy. And right now, I can see an environment where everybody's going to get greedy about the US market. So stay diversified. Diversify between Canadian and US stocks, for instance, because this might provide a better balance for you, right? Look at that. Number 2, monitor the impact of inflation on your budget. See, even if inflation increases gradually, having a budget with a little bit of a buffer can help you. So adjusting your spending when prices rise is a little bit easier to manage if you already have a bit of a buffer. But if you are operating with no slack, it's going to be difficult to manage that. Now, you can't control what the US is doing, you can't control what the stock market is doing, but you can control your own withdrawal strategies. By being more tax efficient with your withdrawal strategies in careful planning from your draws from different accounts, right? Managing which pool of money you take from first can add more dollars to you because you could decrease your tax burden over your retirement. So learning which account to take from first, whether it's TFSA, your non-registered, or RSPs first, and understanding which balance will yield the most cash flow for you is very important. In fact, we have a series going on right now talking about the RSP meltdown, or more broadly speaking, the sequence of withdrawals from your portfolio. Check the links below. And of course, there's other wise tax planning practices like income splitting with your spouse, managing the timing of your Jesus, I can't speak anymore. Let's keep that on the video. So good tax planning strategies will stay good. It doesn't matter who's in power. So splitting your income between husbands and wives, your partners, we need to make sure that you keep that as equal as possible, especially if it's not time for you to withdraw yet. Really assessing your balance sheet 5 years before retirement and trying to keep your assets as even as possible will help you. So that is still good practice. It doesn't matter if there's political changes and how that impacts the economy. It should not change your personal goal. So that is my final action item for you. Review your financial goals. Review your life goals and review what retirement should look like for you. Trump doesn't get to dictate that. See, ultimately, while Trump's policies may bring a shift to trade, the market, and inflation, a solid financial plan anticipates a range of these changes, and it brings focus back to you. What are the things in your life that you can control? I hope this video has been helpful. Please like, subscribe. Stay tuned for the rest of our RSP Meltdown series. Happy planning, happy retirement. God bless you. Don't forget to be your own money hero. Watch the next video right now.